If you're losing trades and you're sick of not knowing why, this is the video you need. Maybe you keep entering at the wrong time, maybe you keep switching strategies every other day, or maybe you're trying to get rich quick and the market keeps humbling you. Whatever it is, if you're struggling to stay consistent, then this video is going to show you exactly why. We're going to go through the 5 biggest mistakes that causes 99% of people to stay stuck and how you can avoid these mistakes to become a consistently profitable trader. Let's go. So the first mistakes that most people make is that most people enter a stock or they buy a stock without any clear reason. So let me just write it down. Entering without any reason. And that is basically one of the key, I would say, first mistakes that most people make. All right, there's no clear indication of why they should buy a stock. All right, they just base it on gut feel, based on the feeling, or they just want to buy something that day and they just randomly choose one stock and they just buy. It is usually driven like by boredom or greed, but it's not really logic, that there's a very clear understanding or clear structure, in terms of the reason why you buy the stock. Or maybe they could have taken a look at the charts, but you have no idea how to read the chart. So you felt that it looks pretty okay and they just decided to just get in. So let me give you guys an example. So this stock right over here is called ACCO Brands, right? I have no idea what stock this is. I think it's one of those stocks that are a little bit weaker. The code is ACCO, right, to this stock, right? And you think that, no, it looks pretty good, it looks pretty cheap as well. It used to be at about $6. It went down to like $5.50, rebounded, but went even lower. And you can see the high was at about $4.60, and now the high was at about $3.80. So you can see that the high actually goes lower. So I would say that this stock is a little bit in a downtrend, and we want to try to avoid stocks like this. So most people, all right, as I say, right, maybe you've heard of this stock from a friend and you think that it looks pretty cheap, right? Your friend probably tell you that, hey, Joey, this stock used to be $6. Now it is only $3.39. Is it cheap? Definitely it is cheap, right? I mean, it's definitely cheaper than a couple of months back. So that is probably the only reason why you get in a stock, because it's cheap, right? But other than being cheap, are there any other reasons why you want to buy this stock? I mean, besides your friend telling you that it's good? No, right? And that's the mistakes most people make, right? They just enter a stock based on some hearsay, all right? And because it's cheap and they get in. So for example, looking at this stock, it will never be in our watch list. Why? Because first of all, you can see that we have formed, as I said, lower high. So it's a bit of a downtrend. And we have actually been breaking what we call support levels along the few months. Look at this, right? A support level, we broke down. Same thing over here. Support broke down. Look at this over here, same thing, support broke down. So every time you can see that we kind of like broke the support level and it starts heading even lower, breaks the support, and right now, potentially we might even see a support somewhere around here. And it seems like we are going to break the support as well. I mean, as I'm talking, right, it seems like it's about to break the support. It might hit even lower. I mean, if you're to firmly break this support level like it does over the past few months. So that's a very clear reason why we want to avoid stocks like this. So if you have no reason why you want to buy a particular stock, then make sure you have a reason why you want to avoid certain stocks. If you have reasons why you want to avoid stocks, you can cut off a lot of noises, a lot of rubbish stocks, right? You just want to focus on the strong ones. So that's pretty much the first mistake, right? Entering without any reason, all right, other than what you hear from a friend, all right, and you probably don't know how it looks like on the charts. Let's move on to the second biggest mistake that I think most people actually make, and that will be what we call revenge trading. So let me just write it down. Revenge trading. So what exactly is revenge trading? As the name sounds, like revenge sounds like, you just want to do something again because maybe you make a little bit of mistake, you make a bit of loss, you want to buy more. So for example, let's say you've bought a stock, all right, and of course you want it to go up, but unfortunately, or the market came down, it turned, you get out, you stop loss, and you lose maybe a few $100s, right? And you feel a little bit frustrated. You feel that, why did it go down, right? It should have gone up. Why did it go down? And it starts going down a little bit more, and you feel that maybe it's time to get back in, all right? Because it's even cheaper, first of all, and you think that you can start to rebound all the way up, and you want to buy even more, all right, to cover the loss that you just made, all right? So you want to buy even more, plus it's even cheaper, so want to buy more, right? So you do what we call revenge trading, all right, and you buy more, right? The only reason was because it is cheaper, and also because you cannot get over the fact that it is now that you make a small loss, so you just want to do what we call revenge trading and then try to cover that loss that you made. Does it make sense? So let's take a look at an example of revenge trading. As I mentioned, right, revenge trading is where you want to buy a stock, you want it to go up, but it goes down, hit your stop loss, but you buy even more later to try to cover that small loss. So let's think about this stock called GoHealth, right? The code is GOCO. Let me just do a quick of a bar replay to see what has actually happened so you can visualize it a bit clearer. So you can see, right, perhaps you have bought this stock when it was like $9 or $10. It went all the way up to $20. So very strong rally, right? You may make some profits. But what happens was we started to see weakness in the stock, right? Started to turn down and we have broken what we call the $15, kind of like a support level. So $15 we broke down. There were some signs of the trend turning back down as well, just by looking at what we call the 20 days moving average. So you might have bought maybe earlier, you could make some profits, or maybe you have bought it at like $16 to $17 and it starts going down and you're making a small loss, or maybe your profits that you have made got much lesser because you sold it a little bit higher only, and you started to go down, right? So the thing is that most people would be what we call revenge trading, all right? They want to buy more at this point in time to maybe cover that small loss. So let's see what has actually happened. So let me just go to play this. And there we go, right? Look at this, right? And it starts coming down and down and down and down, right? I have no idea how low it can go, but the truth here is that if you're just buying as part of revenge trading just to cover that small loss, and it just keeps on going lower and lower, and perhaps if it goes lower you might want to buy even more, all right, to average down and all that. Well, that is very dangerous because there are definitely no clear signs of a reversal, all right? So you don't want to do revenge trading. That is definitely one of the biggest mistakes that most people actually make. So let's go on to the third mistakes that most people actually make in the market. I would say that the third mistake would be most people don't really have a strategy. So no actual strategy, all right? There's no reason why they are buying a particular stock. There's no strategy in place, all right? They're just based on gut feel, or you're constantly changing strategies every other day with no clear process, or you're like pulling out different indicators on the chart, testing them out with no idea on how they really work and how to combine all of them together. And that is, I would say, why most people fail, right? They don't have a real proven actual strategy. They're just combining things here and there, and hopefully it all works out together, when they're all put together. So let me give you guys an example. So for example, you might have pulled out like, lots and lots of indicators because you think that, if you have more indicators on the chart, then you get much more confirmations, and it will help you to make a better decision whether to buy or sell. So this is like Microsoft, right? So you might pull out the RSI because your friends say it's good. You might pull out the MACD because you watch it on some YouTube video. You might pull out the TSI, there's a stochastic, and all the different indicators, the Bollinger Bands and everything, right? And you have the chart right at the top, and then you might get confused and lost, like what do you do right now, right? Do you buy or do you sell? How do you read all these different indicators in totality, right? How do they all work together, right? Even you have no idea, all right? And you get what we call analysis paralysis, and that's why most people fail as well, because they don't have what we call a proven strategy, right? It's just bits and pieces of indicators combined together, and you have no idea exactly how each of them work, all right? And more importantly, even if you know how each of them work, but how do they all work together with one another? So this is like Microsoft, the very messy way, the many analyses, many indicators kind of a method. Or you could also have what we call a proven strategy, whereby something like this over here. And there we go, right? You can see that now we have a very clean chart. There's no indicators floating around all over the place, right? And what you could do was just to pull out like a moving average to gauge the trend of Microsoft, to guide you whether are you in the same direction as this trend, or maybe you're in opposite direction, right? So if you're looking at trend trading, then you want to be in the same direction as the trend. So a simple moving average would do, right? And you could have what we call this indicator that I have, right? What I call the one good trend pro indicator, whereby in a matter of like seconds I could turn it on and it shows me bullish and bearish signals. So you can see very clearly for Microsoft, well, we actually had a couple of bearish signals coming out on it. All right, the trend was down as another confirmation, and it starts going down and down. So very simple, right? Signal for you to not buy, to be patient, to wait because it's bearish, right? It's going down. And then maybe to get back in again, if you were to see what we call a new green 1 GT bullish signal, all right? Rather than, like this previously where it complicates things, all right? There's so many indicators, there are no signals, all right? Nothing to guide you to get in or to get out, all right? You have to like manually combine everything. I think that's where you want to be careful, all right? And you can get confused as well, right? So signals to get out, to take some profit, bearish signals, and maybe to get back in again if you see a new bullish signal, all right, to ride the reversal. And that's how it works, right? That's how we have wrote Microsoft back up as well. So let's move to mistake number 4. So I would say that most people actually have this mistake whereby they kind of like force trades because they haven't traded in a while. So it's like kind of like taking like force trades. So you might have stopped trading for a while, right? And then now you get excited again because you know some of your friends have made some money in the market, right? So now you look at a few stocks and you just want to force yourself to buy something today, all right? It doesn't matter what stock, right? Just buy something today, just get in and hopefully you make money out of that particular stock. So that's what I call force trading, all right? You just want to get in on the particular stock, all right? And convince yourself that this weak stock or this weak trade setup will potentially turn bullish because you buy it. So you just want to buy something and be active even though when there's clearly nothing to buy or when like the market is weak, all right, and there's nothing clean, all right, that gives you an idea or a signal to buy. So let me give you guys an example. So this stock is called CABO. No idea what stock this is, right? Definitely not in my watch list, but I can see that it's definitely weak, all right? Probably in a downtrend. We have formed what we call lower highs, again, from like $400 to $300. Now it's only like $126. So most people might want to get in on stocks like this, all right? You know, first of all, as I mentioned, it could be cheap as well, all right? And maybe at a point in time on the day itself, you just log in and you look at the price 126 and it was like, you know, 140 just a week ago, and now it's cheaper, right? So you just want to force yourself to get in on this particular stock. And you know, it used to be, look at this, right? I mean, it used to be like 350. We have broken support after support and it just goes down and down. So we want to avoid stocks like this. So forced trades are normally not the trades that will make money because you know you're just forcing yourself to get in for the sake of getting in, right? Especially, I mean, if a stock is in a downtrend, you don't even want to think about getting in, right? Let alone forcing yourself to buy something that is in a downtrend. You only want to think about buying when there are clear signs of like a reversal or a stock that is already strong, all right? Then you don't have to force yourself, right? That it comes naturally, especially when you see a bullish signal and all that, you get some confirmations, then you get in. You don't want to just force yourself to buy stocks that are weak. And for this example, like cable one, as I say, right, I have this indicator, I call it the One Good Trend Pro indicator, all right? And in a matter of seconds, for any asset classes, I can just quickly turn on the buy and sell signals. All right, so you can see right over here. Well, previously we actually had a couple of like, you know, bullish signals coming out and it starts moving up, right, from like about 325 all the way to 400. But what happens, right, we got bearish, and bearish, more bearish signals coming out for the past 6 months, and it starts going down from 400 all the way to 126. So that's the reason why, you know, I mean, if you have what we call a system, a proven system, or maybe an indicator or like a tool that guides you on what to do, right? To not force yourself to get in or maybe to be patient, to wait. I think that would be really useful, all right? You would not make these mistakes of just getting in for the sake of getting in. So one of the mistakes that most people make in trading is that most people have what we call the get rich quick kind of mindset, right? So get rich quick. So you believe that in the stock market, you know, in order to get rich quick, you need to take a lot of risks. You need to buy big, all right? Just buy the maximum amount of stocks, number of shares, and hopefully the stock starts moving up and you make a lot of money, right? You grow from your $1,000, you grow it to $5,000 and eventually $10,000 in a matter of weeks, right? So most people believe that, you know, trading is the way to turn small money into huge profits in a very small amount of time. That's what we call the get rich quick mentality. And because you have this mentality, all right, most people who have this mentality will fail. Why? Because they are taking a lot of unnecessary risks. Or of course, it goes up, great, but if it comes down, that's where you wipe out a huge chunk of your capital because you're always thinking about making money, about huge profits, huge returns in the shortest amount of time, right? It happens, great, but if it doesn't happen, that's where your losses will be magnified. So because of you actually chasing all these quick wins and, you know, combined with all the mistakes that I mentioned above, right? That is where I would say, you know, most people lose money in the stock market. So trading is not really a get rich quick kind of scheme. Of course, you know, it is about taking a series of trades, right? 10, 20, 30 trades in a very consistent way, based on the proven strategy, you know, to guide you to get in, to get out. And based on all these trades, 20, 30 trades, right? That's where when you make, you make more. When you lose, you keep your losses small. That's how it all adds up. It's not really about home runs, about, one stock making 5,000 or 10,000, and the next trade you lose 20,000 and it's all gone, right? No, right? That's not trading, right? That is what we call the get rich quick mentality, a little bit of gambling, a little bit of like 4D mindset, right? So you definitely don't want to have this, get rich quick mindset when you're trading, because, on the other hand, it could cause you to lose even more money. So let me show you guys some of these stocks. So, you don't have to have the get rich quick mentality or to make a lot of money within a couple of weeks to be rich, right? You can let the stock slowly play out, all right? If it's positive and if it's an uptrend, man, no, let it play out. It could be a couple of months. I mean, if you can go even more, then why do you want to get rich quick? You can, slowly get rich. I think that's better, right? So let me give you guys an example. So this is Spotify, SPOT, right? One of the, favorite stocks that we like since last year. A couple of bullish signals we've caught for it many times. And you can see that, since like maybe June or May 2024, well, we had a couple of bullish 1GT signals coming out, right? You can see that, it did not go up in like 1 week or 1 month, right? But it took like about 7 to 8 months, where I would say that it was like about $300 all the way up, whereby we got a bearish signal, it starts coming down. That would be a 55% in about 6-7 months. I know some of you might be saying that, well, 6-7 months is too long. I want it in like 2 weeks, right? Well, if you have that, then that's a get rich quick mentality. But even a 55% gain in 6 to 7 months, I think that's pretty good, all right? And you want to ride stocks like this, right? Give the stock time to move up, right? If you can move up more, great, you ride it. You don't want to just based on this get rich quick mentality. So you make a few $100, you get it, and you find your next stock to make a few $100 and you jump here and there all over the place. No, all right? If the stock is good, you ride it, you let the trend play out, and you maximize your profits along the way, and you get rich slowly. You let the returns or the profits build up slowly, all right? You don't have to rush, all right? Don't just get out and because of this get rich quick mentality and only make a small profits. And you can see that for Spotify, well, we had another 2 new bullish signals coming out. Of course, the short-term trend has started to turn up as well. The green 20 days moving average line has pointed up as another confirmation. It is still pointing up. So I think it looks pretty good, all right? I mean, it started to push up by, I would say, more than, let's see, about 29% in about 2 months. I know it might be a bit slow for you guys, but it's good enough for me, all right? And that's where you allow it to move up and up, all right? Get rich slowly, take steps to protect your profits as it moves up. So anytime it comes back down, we still make money, all right? So it's not about getting rich quick, all right? It's about, getting rich slowly, making the profit slowly, all right, and then taking steps to protect the profit so that your richness, all right, or your get rich quick will not be wiped out, so that you stay profitable, right? Rather than getting rich quick, make a lot of money, and then one day you lose everything. So that would be mistake number 5, right? Most people, I would say, have the get rich quick mentality, and you definitely don't want to do that in the stock market. So here are the 5 biggest mistakes that most people make in the stock market, and you definitely want to avoid all these mistakes to be consistently profitable. If you're tired of trading like this, right? Random entries, emotional exits, no plan. And also, if you want to build a real strategy that you can stick to long-term for longer-term profitability, well, then what you want to do is that you can test drive my one good trend or my 1GT light indicator for free, all right? The link is right below the video. Test drive it like what I've shown you guys just now. It guides you on when to get in, when to get out, so there's no guesswork, there's no emotional, things affecting your mindset and everything like get rich quick, right? It can help you to time your entry and your exit much more precisely, and that's where I'll break it all down in the training as well. So go to test drive my 1GT lights indicator for free. Link is right below. This is the same system that I've used for many years now, and you can go to use it as well. All right, I'm sure you'll find it useful. So yep, Joey here. Thank you so much for watching. I look forward to see you in the next video. Go to hit the subscribe button, like button. I shall see you soon.